So hello everybody in Business 330. As I previously told everyone through an email, I won't be in class Tuesday, so I want to make a video. We're going to do Chapter 2. Remember, we skipped over to Chapter 3, and we'll do Chapter 2. I believe your Zoom project is due on the 20th, the first one. Alright, so in any case, here is Chapter 2. And the first thing we have to know is money can come from external sources. They either can come through a bank, like a financial institution, a commercial, or a savings bank, or a credit union, or you can raise money through financial markets, or get money in a private way through a venture capitalist or an angel investor, someone who's willing to invest in your idea. Also, there's a lot of other ways, somewhat modern ways now, right? You can basically do a GoFundMe or basically go online and have people send you money. If you have a great idea and you try to pitch to them your idea. So that's the obvious way you can do these things. All right, so banks are intermediaries between people who put their money in for savings and businesses and who basically want to borrow, right? So individuals will be the net supplier of funds while businesses try to borrow. Basically, as you hear me always talking, putting the money in a savings account is a waste of time, and you basically shouldn't do this if you can invest, because inflation will take away the 0.1% that you're getting from the banks. They're making a killing on the people who put money into savings accounts. All right, so you have commercial banks that provide funds, and credit unions also, right? And you also have investment banks that basically invest companies in raising capitals. You may have heard the term initial public offering, or IPO, and they help companies raise money and sell stocks and bonds in an initial public offering. And we'll talk more about investment banks later. All right, so basically the GlassSteagall Act was something that's, at one time, investment banks and commercial banks were able to merge as one. And basically this separated them, okay, and the activities were separated, but then back in 1999 they put them back together again. All right, so financial markets are what we all know and love. The stock and bond markets, right, and they trade marketable securities. And short-term marketable securities is called the money market. When you get a CD in a bank, right, that's a money market instrument, right? Or you can even put money in a money market mutual fund. And anything, basically, it's divided over anything less than a year is considered money market, and anything over a year is considered capital markets. And again, the private placement is just simply an investor, a single investor, or angel investor, or a group of investors. All right, so the primary market is basically the financial market in which securities are initially issued. So, an initial public offering, if you had to start at a startup and it was doing so well you needed more money, you would go to an investment bank. And they would basically do an initial public offering, and this is called the primary market. And basically, this is to help you initially raise money to run your company, either through the stock or bond market. And the intermediary, again, is the investment bank. And the secondary markets and the stock markets, right, are simply you and I as we trade securities back and forth. So we basically, they're not new issues, and they're basically secondary issues that you and I basically trade, and I show you my accounts all the time. All right, so the money market, again, is short term, less than a year, right? And here's just a list of some treasury bills and commercial paper. The commercial paper is basically banks, corporations loaning money to each other, right? They issue, short-term loans. And again, here's CDs, right? We talked about CDs a little bit. All right, so the capital markets, again, are like the stock markets. So you have the bond market, and here's the common and preferred stock. And obviously, as we talked about in class, if a company goes belly up, the bond holders get paid first, and then the preferred stockholders get paid, and then the common stockholders. So the common stockholders bear the most risk, and therefore they want the most return. All right, so you should probably, this is a good introduction to when we do the chapter on bonds. So you should go over this problem. And the interest paid on a bond is called the coupon interest rate, 9%. So that'll be $90 a year. And you get a payment every 6 months, so it's $45, right? And then you get your $1,000. Well, see, this is redundant, right? You get your money back at the end of year 20 here. See, this is $1,000 par value. All right, so basically, a broker market, so like the New York Stock Exchange, you've probably seen on CNBC, there's a trading floor. They show you people running around on the New York Stock Exchange, and those are called broker markets. And the term for markets such as NASDAQ are called dealer markets. And NASDAQ, there's no trading floor. Shares are traded on basically computers, right? Everything's done over computers. So anytime an order is placed, no matter where it's placed, there's called a spread. So there's always two-sided pricing with stocks. There's a bid-ask spread. So you should know this, right? When you buy stocks, you'll pay one price. When you buy them, you'll pay a different price when you sell. All right, so capital markets basically provide for efficiency, and supposedly there's price discovery where everyone shares in the same amount of information, and probably that's really not true in real life, right? You can see here the wealth maximizing investors and determines and publicizes prices that are believed to be close to their true value. And hopefully, that should be realistic, but a lot of times it's not. All right, so this is a real interesting topic, behavioral finance, and you can take a class in this today, right? This is an emerging field that blends ideas from finance and psychology, and it's the whole thing about the psychology of investing, right? And it's good. It's an interesting thing, and if Stony Brook ever gives a class in behavioral finance, you should take it. And people basically trade on their own behavior and how they act in a psychological way. And you guys can talk about ethics of and everything. So, and this is a good introduction to the financial crisis that took place 10 years ago when you were younger, and what products were used. I suggest you go online and do a Google search on what happened in the financial crisis of 2008. It's pretty fascinating, and it was a scary time. I myself lost about $300,000 in that period. So they basically sold junk mortgages and repackaged them. You can see here how the crash of housing prices, how they were soaring, and then like boom, and then the crash occurred right around 2007, 2008. And you can clearly see the repercussions with bank stocks, right? This was here you go, bank stocks were on sale, a great time to buy bank stocks. And you can see the prices plummeting here on bank stocks. All right, there's a whole bunch of things here on security acts, and you could basically look these up. There's different security acts of 33 and 34. All right, so what I'm going to do is I'll stop here. This is about 11 minutes in, and then I'll do a part 2 later. So the files don't get too big when I save them, okay? So I'll stop at business taxes, and I'll pick up later, and I'll do a part 2. All right, talk to everybody later. If you have any questions, just email me.